Very well, and I think for everybody who's joined us today, you genuinely couldn't have chosen a better year to be doing this. The market is the best. There's been two real great times in the market that I've seen over the last 24 years, and that was 0708 into 0910, which is when we sort of aggressively went in, and then COVID was a fantastic market. Now we're seeing exactly the same, and it genuinely is the best time since COVID to be out there doing deals. So for those of you that have signed up today, those of you that are listening, those of you that are going to get this training today, you genuinely couldn't be in a better position. I'm going to take you through the market predictions. So to set the frame for today, a lot of this is about understanding how markets work, and what I'm going to take you through is in 2026, what do you need to do to capitalise in what other people would see as a very difficult market? Now, we've been doing these predictions I've been doing them for 14 years, and this is the 6th year that we've shared them publicly, normally within our private property entrepreneur members community, and this was last year's. And to give you some confidence, pretty much everything that we predicted came true. The only thing we got marginally wrong was inflation was higher than we were expecting, but it was pretty much bang on. And the result of that was over 2025, we were able to complete on £7.2 million worth of deals, which, when you consider everybody else is nervous and there isn't deals out there, or, they're not getting involved, there absolutely is. That created £2.5 million worth of net equity with £1.5 million worth of net cash flow. And in what most people would say is the most challenging market they've seen, we went out there and made over £4 million in 12 months in a tough market. This year is going to be even better if you know what to do. And this is my job today, is to set the event up to give you confidence to go out and do this, and actually the conviction that the market is better than everybody else says. This is my job over the next 45 minutes, is to bring you up to speed on everything to do with the economy, how to master the market in a challenging time. The Renters' Right Act is a big part of why the market's so good, but it also makes it quite dangerous. You've got to make sure you understand what you're doing. And then finally, deals. Give you the confidence to go out there and actually do some deals. So my name's Daniel Hill. For anyone I haven't spoken for previously, I have been in business for 25 years this year. I had over 40 companies. I've bought, sold, started, scaled small startups, medium-sized companies, and international multi-million pound organisations. So whatever you want to do at whatever size, this is the blueprint that I used, and it's the one that I would recommend you use going into 2026. So I started off literally on the buildings when I was 15, physically building them. I built a portfolio of companies for up to 2010. When I sold them. I then moved into property by doing Simon's mastermind program, and those of you considering getting into property, I would highly recommend the 3-day accelerator. See if it's right for you, and then go on and do the 12-month program. I did that, and I was awarded top performer. I broke the record for the most amount of money made at that time in 1 year, and then I went into property, and through that I went into property. I bought single lets, apartment blocks, small ones. I developed big ones, listed buildings, commercial buildings, hostels, office blocks, actual business centres, private schools, even bought my own house using a strategy that I learned from Property Investors Network, and then most recently buying stuff, motivated sellers, auctions, HMOs, and then we've most recently gone into pubs, nightclubs and hotels with our most recent acquisition. Anything you want to do, property is the quickest way to do it. And what I'm going to take you through now is to understand why, if you don't, not just that you could do it and it would change your life, but actually if you don't do it, you're going to be in a difficult position. Because if you do it from property, I learned all this stuff from events like this. It enabled me to retire with full financial independence, living off the steam at age 35, dream car, dream house, dream lifestyle. And I get all of this for free because I earn my income from assets, not my income from activity. I'm still an active entrepreneur. I still do investments, developments. I still own trading businesses, but really my wealth is in assets and my income comes from those. So this is the aim of the game today. How can you go out there and actually do it? Well, the first is understanding it's a mindset piece. And there's 2 mantras I would encourage you to consider, which should make it more accessible for you. The first is that it's all a game. I don't want to be blasé with it, but life is all a game, Business is all a game. Property is all a game. Yes, there's risks, there's finance, there's lives involved, so you can't be blasé. But it is really all about game theory and understanding how to play the game. And the second, a lot of you will be sitting there thinking you're learning about this year because you want to go into property maybe next year. Timing is a moving target. There is no perfect market. There's good markets and there's bad markets, but the main thing is the more challenging the market is, actually the more lucrative it is. But you've got to know what you're doing. And this is where we are now. For 2026, if you can understand the UK economy, you'll be able to go out there and do more deals than anybody else, more lucrative deals than you would have seen in the last 5 years, and make more net worth and more income than any other business model that I can see at the moment, with the exception of AI. And even in that space, you're going to find it very challenging to get these levels of returns. So when we think about the economy, what's actually happening? Well, the reality is the UK is dying. I went out in Doncaster last night. I went out in Manchester over Christmas. I went out in Nottingham. Whether you look at it quantitatively and the data sets of the UK, they're all going south. Or qualitatively, walking around those towns and cities that I mentioned, it's visible that the pubs are getting quiet. The restaurants are slow. People are actually struggling. And this is what the UK is. This is what's happening in the UK. And I can't see it changing anytime soon. If you look at the stats for the UK, productivity since the global financial crisis has just been flatlining. This isn't a new thing. GDP has been flat. It's just not going anywhere. The UK, for the last 200 years, has been one of the top 5 economies. Is now, for the first time since the 1800s, fallen out of the top 5 economies, and is now fighting with France for 6th and 7th place. Average wages, when you adjust them for inflation, again, are just flatlining. People think they're wealthier because they're getting pay rises and they're buying stuff from Temu and Shein, and they feel like they're wealthy. They're really not. The real life disposable income and lifestyle of everybody is going down. If you compared it to somewhere like America, the UK has less the average disposable income per capita for the UK is lower than the bottom 5 states of America. So disposable income in the UK is lower than the bottom 5 states of America. Affordability, if you look at this graph, this shows you the cost of getting a house in the UK against what incomes have done over the last 40 years. In the UK, a good sort of affordability is about 4.5-5 times. So to buy a house, 4.5 to 5 times salary for the average price is where a good affordable economy is. In the UK, it's now 8.4 times the average UK salary. And most people, unless they're buying with either help from a family or with a partner, they can't actually afford to buy a house, so they rent. Even when they're renting in a good, stable economy that's well balanced and gives people money to spend, really, you don't want to be spending more than 30% of your annual or monthly income on property prices. In the UK, it's now 34%. 34% of the average salary goes on, or the average rent is 34% of the average salary before you even include overheads, running costs, bills, household costs. It's just not an affordable place to be. Who's leaving the UK? Most people, the next generation. I think somebody told me this week, 65% of people leaving the UK are under the age of 35. So not only are more millionaires leaving the UK than any other country on the planet, it's also the next generation of millionaires. So the wealth in the UK is going to change dramatically. And it's just not a great place to be. The UK economy, for the masses, is in a really difficult position. And the problem that this creates is a wealth gap. Now, we predicted this in 2020. It came true post-COVID, and it's visible now. You'll see it after I share it with you, walking around in your day-to-day life, walking around town, speaking to your friends and family. What you're going to see now is a big wealth gap. And what's happened is you used to have the poor and the wealthy and then the masses, the middle class. The reality is now the middle class are just slipping down this hill with less disposable income, higher overheads, quality of life just dramatically reducing. And really, it's only those few wealthy that are getting better off. And when I said about the majority of people are the quality of lifestyle and income is going down, it's basically a death by 1,000 cuts. Some of them don't even notice it. But if they were to compare their lifestyle now to 3 years ago, 5 years ago, and they see what it's going to look like in 5 years against now, it really is death by 1,000 cuts for the masses. But there is a solution, because whilst the masses, the majority, over 95% of the population are feeling the pinch, the wealthy are going out there and actually making this a good thing. You know, it's sad to say, but people like myself, over the last 5 years, I've made more money than ever, and it's been easier because I've understood this model that I'm going to share with you today. You can actually escape the wealth gap by going out there and buying assets. And whilst all those stats that I showed you from the last 40, 10 and 5 years are really detrimental to the masses, over 95% of the population, the top 5% who own assets have just gone through the roof, you know, without actually having to do anything. If you own gold, so I own gold, over the last 5 years, it's gone up over 100%. So it's doubled in value, and I've done literally nothing, and my net wealth in gold has doubled. You look at things like the S&P 500. So I invest in the S&P 500. I have done for years. I invest my money, my daughter's money, Junior ISA, S&P 500, Vanguard, £5,000 a month. Just leave it, go whether it goes up or down. In the last 5 years, it's nearly doubled. It's gone up 91% in 5 years. I've done nothing. I've just owned assets, and they've doubled in value. Property prices, they've gone up 25%. Whether you own $1 million or 10 million or 20 million pounds worth of property, for every million you own, you've made £250,000 over the last 5 years from doing nothing. That's £50,000 a year from doing nothing. That's more than the average UK salary from doing nothing. And those assets that you own that have gone up in value and increased your net worth, the rent has also gone up over 40%. So again, for every £100,000 worth of rent you collect, over the last 5 years, that's gone up £40,000. So that's an extra £4,000 a month, again, from doing absolutely nothing. And it's not like nobody else can go out there and do deals. There's liquidity, there's affordability, mortgage approvals for you to go and do these deals has consistently gone up over the last 3 years. And the amount of people, the competition that are out there is going down. You know, the amount of time it's taken month on month to sell property is going up, which means demand is reducing, which means the supply for you to buy at discounted prices. If you know how to play the game, the UK is the best place to be. I'm flying to Dubai on Monday for a couple of weeks to see some friends. And people say, you know, if you say Dubai is so amazing, why don't you move? Well, the sad thing to say is for people like me who understand how the market works, I couldn't go to a more lucrative country because I know how to capitalise. Now, that is sobering because my friends, my family who don't understand this and haven't taken my advice are struggling. You're going to see it. You probably know people who are experiencing this. But our job in today's event is to educate you to be able to go out there, stay in the UK, enjoy the country, work with the economy, and go out there and capitalise. You're only going to be able to do this if you can master the market. And the reality is, most people don't understand how the market works. So the bad news is they go out there, they read the headlines of the newspaper, and they can just see everything is doom and gloom. I've been reading the broadsheets for 20 years. I've actually stopped reading the daily broadsheet now because it's gone from being economics to politics. Everything is politically driven. Everything's a load of noise. If you listen to the news and you actually soaked it in, I can understand why there's very low competition. But when you can understand how to capitalise, you can observe the masses who are scared, you know, to do anything. You can do the opposite and go out there and do deals, and you can actually capitalise by mastering this market. This is the 2026 property market predictions, and I shared with you at the beginning the 2025 ones came true. We made over £4 million last year from following it. This is the model that I'm going to share with you so you can go out there and do the same. The first thing to note, which should mean that you tune in for the whole day. Every session, you have a pad, a pen, and not only do you learn, you go out there like Katie has and actually take action. This is the best market since COVID to go and do it. I can't see any reason why you wouldn't go and do it. And for those that do, it is the best market that I've seen in 5 years. So this is the model, same layout as 2025. For those of you that joined us in 2025, I drafted it in July last year. So we're now obviously in January here. And the only thing that changes what I'm predicting is the unemployment rate. Because if the unemployment rate moves in the UK and it's currently up at 5%, it's quite likely some of this data would be adjusted to accommodate that. Primarily, interest rates will come down more aggressively if unemployment goes up. But for as long as inflation is where it is, I don't think that's going to be the case. Now, we said inflation would stay steady through the summer and the autumn, which it pretty much did, and then we said it would start to come down in the new year, and now we're seeing that, you know, it's come down from sort of 3.5% closer to 3%, and I think it will just gradually come down. The government are predicting that it'll be down to 2%, which is their target, within the next 3 to 6 months. I just don't think that's true. I think with all these underlying costs, national insurance, minimum wage, the new minimum wage coming in March, global conflicts, supply chains, I just don't personally see it, but we'll wait and, you know, we'll see if I'm right or not. This is what we're forecasting. It'll start to come down, and it'll gradually go down to about 2.5%-3% by the end of the year. Interest rates, we said, would gradually come down. We forecast that by now they would be down to 3.75%. We had the drop in December. I said it would be December or January. It came in December. I don't think we'll see another one at the next review. I think it'll be a split decision. But whether it does or it doesn't, I think it will gradually chip down to about 3.5% over the year. I don't think you're going to see any aggressive drops, so I wouldn't really be holding tight for any big refinances. Mortgage rates are starting to follow that. You know, you're now seeing confidence and clarity in the market. So what's happening is the lenders are starting to get confident. They're actually also starting to get competitive to get money out the door. And those buy-to-let rates are now down to, as an average, at 4.7%, which is pretty much where we predicted. You can even get some lenders closer to 4% in the buy-to-let space, which is really quite groundbreaking. Although for a lot of them, the gearing is quite low. So it may or may not be something that you choose to use. Property prices, what's going to happen now? If you read the headlines, it will say property prices are the lowest they've been. You know, year-on-year growth is 0.2%. The market's slowing and potentially even stopping, and property prices are going to go down. I genuinely don't think that's going to be the case. I think what's going to happen is, once the days are getting longer. I've actually just had to move where I was sitting because the sun's out. It's getting warmer. The days are getting longer. Optimism to a degree is starting to come, but people still need to buy houses. And what happened at the back end of last year is the budget froze the market for 3 or 4 months, not just in property, the whole economy. People didn't make decisions. I think that's going to create pent-up demand, or has created pent-up demand. I think as we go through the winter, that's going to start to come out. And I actually think we're still going to see 2 to 3% property growth through this year. But if you read the headlines, that's not what you'll get. What's going to happen to rents? I think rents are going to go up and up and up, as they have done. Last year, we predicted they would literally go through the roof, and they have gone through the roof. You know, they've gone up 40% over the last 5 years. But I think what's going to happen now is you're going to hit a glass ceiling. I'm going to talk about that when we talk about the Renters' Right Act. And then what's going to happen to GDP? I don't think there's going to be a big crash. I don't think there's going to be a big recession. Equally, I don't think there's going to be any sign of any significant initiatives, stimulus, or growth. So I just think the UK GDP is just going to sort of tick around 0.5%, 1%. It's going to go up and down, but only marginally. I just think it's going to be a pretty, it's just going to be slow. The way I explain the UK economy to the property entrepreneurs is as a big trusty steam train that's just going to keep chugging along, and it's like big old trusty, it's going to keep doing what it does. And for those who know to capitalise, they'll do well. For everybody else, the money is going to move from the mass market to the bottom of the market, and then all of it will filter up to those who own the assets, and in the UK primarily property. The Renters' Right Act is something that you should be very aware of. It's something that you should have a degree of caution around. But if you understand it, it's something you should actually be quite pleased for, because any challenge or disruption to an industry or market that reduces the appeal, reduces competition, and where you find low competition, you find high margins. And this is what you're going to see from the Renters' Right Act. Now, there's lots of stuff in there, and if you go on the government website, you can download a document. It's very palatable. I actually boiled it down and gave it to our property entrepreneur members, but you can read it yourself, go through it, and pick out the key things. There's stuff that you need to know, but really the only one thing that you need to be aware of is possession claims. Now, possession claims, the ability to remove a section, remove a tenant with a Section 21 is being removed from the 1st of May. So because of that, you've got to understand how possession claims work. Now, if you're in a space of things like rent to rent, they're things you should be very concerned about. And if you restructure it using head leases, superior leases, and just use a different structure, which is what we taught our property entrepreneurs, then you will be able to completely circumnavigate it. It won't be an issue, and you'll be able to bulletproof your business. If you don't, you could get caught. That's the main thing you need to be considered from a sort of negative point of view. But the good thing is what will happen is the supply of rental properties in the UK is going to go down, because landlords who are, in the market are going to look at it, especially the older landlords who are looking at retirement, who own a lot of the property. They're going to look at it and just think, this is getting harder and harder and harder to actually be in our favour, and especially if it's in their own name and they're now getting even more tax on the gross income. For a lot of people, it's not even actually viable to own property. So whether it's the existing landlords leaving the market or it's new landlords coming into the market, the reality is the supply of rental properties is going to continue to go down, which is good for business. The demand, however, for rental properties is going to continue to go up. Every year there's another generation that leave home and go into the rental market. Demand's going to go up. You've got people from other countries still coming in who need property. You've got less rental stock for that demand. So the demand and supply equilibrium is going to be a shortage. And, that's going to continue. The listed price of rents, and this is something a lot of people don't appreciate, is actually going to go up. Because what it says now in the Renters' Right Act is you can't negotiate rents. So if you list a house or an apartment at £700 a month, what normally happens is you list it at 700, you get 5 offers, or this is what it's been like for the last few years. You get 5 offers, 700, 725, 750, and you tend in most cases to go for the higher rent. Now, that's actually been banned and made illegal. It's actually illegal now to accept a tenancy at a rent level that is higher than whatever you list it at. So what's going to happen here is anybody savvy, like myself, yourselves, who have properties or want to get into property, is rather than list it at 700 and then negotiate above, which you're not allowed to do, you list it at 800 and you'll negotiate below, because you're allowed to take rents below. So you list it at 800, people offer 750, 700, and what that does, just by osmosis or just basic market economics of pricing, is it just forces the rents up. So the listed price of rents is going to continue to go up. So demand's down, supply's down, demand's up, rents are going to keep going up. For those of you that understand how to play the game, it's going to be a great place to do business. Lots of landlords. So since COVID, with the first 6 months of COVID, I went from developing property at the top of the market, £900 a month, fully furnished, boutique studio apartments for professionals. I went from the top of the market to the bottom market within 6 months, and I haven't moved. Since then, I've been doing social housing, homelessness, commercial, hostels, emergency accommodation, second tier accommodation. I've basically moved in 2020 from the PRS to social. So like the social space of the market. What you're going to see is more and more landlords do that, because the social space, not only is it more beneficial because you can get a 5-year lease rather than a 6-month tenancy, you can have one tenant rather than 15 tenants. The tenant pays the maintenance, the utility bills, the compliance, the certificates, the management costs, rather than having to do all that yourself. It basically halves the problems and doubles the profit. So more landlords are going to move from the PRS to social for basic economic reasons, but also what a lot of people don't appreciate is the social housing space falls outside of the Renters' Right Act. So all of this new regulation that crushes some portfolios doesn't even apply to the social space. So more and more investors are going to do that. And then finally, this is a big risk that I would encourage you to watch out for. And I actually mentored our property entrepreneurs in our war room. So we have 200 property entrepreneur members. Some of them have been with us for a decade, and every month we give them updates like this and we support them in how to get out of it. This is a big thing that I trained them on yesterday to make sure they don't get caught out. The problem you need to avoid is what's going to happen now is rents are going to go through the roof, and actually they're going to hit what I would call an affordability ceiling. Now, for the last 3 years, between tenancies or using Section 13s, we've increased the rents as much as we can because there's been affordability. Rents will continue to go, but they will actually go above that affordability ceiling. And what that means is you're going to see people start to have issues with arrears, where people physically can't afford to pay the rent, bad payers, and then actually issues with evictions, because now you have to wait 3 months before you can even serve an eviction notice. The current possession court, if you have to go all the way through court, is currently 6 to 12 months. With all of this new stuff coming in, that's going to get even harder, and you could end up with a tenant in your property not paying rent for anywhere from 6 to maybe 18 months, even 2 years not paying rent. That's going to be a significant issue. And what I would focus on now is, rather than driving the highest rents, I would focus on value for money. When you look at affordability, income, and security, I would be looking for the best value for money and maybe taking 725 rather than 750 from somebody that has got 100 grand a year income rather than somebody that's got 40 grand a year income. So the Renters' Right Act is going to have a big, significant impact detrimentally to those who don't understand it. But again, the good thing for you is the more bad news you hear in property, the more good news that means for you in business. I actually really enjoy seeing the bad news in the property. Property market's going to crash. Being a landlord doesn't actually make money anymore. Property prices are going to drop. There's going to be a recession. Don't do this, do that. All of that bad news is actually good news for us as investors, because we want to capitalise where there's low competition and there's high margins, there's bigger returns to be made. If you look at the competition for the next 12 months, we're going to go to a Q&A in a moment. If you want to look at what's happening in the next 12 months, landlords, so this is a survey that was done in back end of last year, and the Times went out to all of the landlords that they had on their database and asked them what they're planning to do with their portfolio in the near future. So next 12 months is this year, 2026. Next 5 years is obviously up to 2030. Only 4% of your competition are going to buy more in the next 12 months. So 96% of the people you would have been previously competing with now are not going to be competing with you. They disappear. They're not interested in buying more. 73% are going to stay the same. Again, there's no competition. 20% are actually going to leave the market. They're considering selling up, which means 1, there's lower competition, and 2, there's stock you could actually go out and buy. And then obviously 3% said they don't know. If you wanted to look at a market where you want to go and play the game, 3 or 4 years ago, the market was so hot, post-COVID, everything was like open day viewings, people taking offers on clipboards on the way out. It was best and finals for everything. It was a nightmare trying to do deals. I actually took a year off when my daughter was born because I just thought, I'm not competing in this market. It's just not for me. Last year, I didn't even mean to do that many deals. We ended up doing £7 million worth just because the market was so good. You want the market to be quiet. You want the market to be slow. You want there to be high volumes of stock and low volumes of buyers. And statistically, this is exactly what you're seeing. If you tune into today's speakers and you get the vibe that property is a long game, we're buying stuff to hold, we're buying it to have for the long term, that's where the money is made. Because all of these things, yes, we have to pivot, we have to adjust, we have to sometimes go from the top of the market to the bottom, or the bottom to the top. But if this is something you're playing for life, long-term asset holding and wealth creation, you will always win. The basic fundamentals of economics mean a market has to adjust to be commercially viable, which basically means for as long as there's a rental market, or any market, but let's say rental, for as long as there is a rental market, people need to rent houses, for as long as that's the case, it will have to be commercially viable over the long term, otherwise people will leave. If it's not commercially viable, they will leave. So what happens is these things come in, there's a couple of years of it adjusting, some people leave, some people suck it up, and then what happens is eventually rents increase, or costs go down, or property prices go up, or they come down. The market is just there to basically give you a return. It's just the way the world works. And then finally, deals. Today is all about getting you, 1, the clarity, and 2, the confidence to go out and actually do deals. My job this morning to open the event is to show you how you can do that in the economy. I'm doing it. We have 200 plus community members on Property Entrepreneur who are doing exactly the same, and we want you to go out and do it. And ultimately it comes down to doing deals, and this is the best time since COVID that I've seen. I'm training all of our property entrepreneurs on the best deal strategies to do because I'm physically doing them. I'm showing them behind the scenes of what I do, and we want you to do the same. To me, it feels like COVID. It is high risk out there. The reason people aren't doing deals is because it's dangerous. It's high risk. There's changes. There's volatility. There's a big downside if you get it wrong. But my view, and this is the view that I've had for the last 25 years, having been through 3 or 4 recessions, included the COVID and pandemic, where we made, in the first 12 months, we made £1.8 million, which we couldn't have made before COVID because of COVID. And then in the second phase of lockdown, the second year, we made an additional 3.4 million. So yes, it's a dangerous market. It is now. Yes, it was challenging and nobody else was doing it. It's exactly the same now. But yes, we capitalised. And my job in sharing this with you is to encourage you to be bold. Go out there and be bold with what you're doing. Be brave and read the newspapers and say it's a terrible idea and actually go out there and do it. But don't be foolish. It is high risk, it is high volatility, but it's also high opportunity when you know how to navigate it. For those of you that want to know the deals that we do and that we train our property entrepreneurs on, I don't have time today to cover it, but I do have 10 minutes for a Q&A, which we're going to do in a moment. Next week, I think it's next Thursday, Casey might have the details there, I'm going to do a webinar on the top 3 deal strategies. Now, we don't normally share this outside of the property entrepreneur members community. I've never shared these deals outside of, for 2026, outside of our paying members. But for those of you that have listened to this and are going to tune in today and actually step up and take action, I'm going to share the top 3 deal strategies for 2026 to enable you, whether you're a beginner, advanced or an expert, to go out there and do deals that most people have never even heard of. The majority of your competition aren't out there doing, and I'll show you some examples of the ones that we've done, and the margins you just will not believe, because we observe the masses, we do the opposite, and we do these strategies that most people have never even heard of. So if you want to register for that, you can scan this QR code on the screen now. I'm sure the team are also putting a link in the box. And for those of you that sign up now and today, it's completely free. The webinar is completely free. What I'm also going to do is send you in the post our blueprint prospectus, which includes the blueprint that I use. We're going to send you it, again, completely free of charge. We want you to get educated. We want you to take action, and we want you to actually go out there and do deals. So join me next week for the follow-up webinar. I'll take you through the top 3 deals. The link is in the show notes now, and the link is in the chat box now, and the QR code's on the screen. And what we're going to do is we're going to post you out ahead of that a copy of the blueprint prospectus, so you can actually understand the blueprint that I've used for 25 years to build these businesses, the blueprints that we use to go out there and actually do the deals, and the blueprints that our 200 plus members, including Katie, are using to go out there and make money in a challenging market where most people are running for the hills. So I hope you got value from that. I hope you enjoyed it. We're going to get as many questions through as we can now, and I'll hand back over to Katie to host.
Thank you, Daniel. That was very, very good. Guys, the link is in the chat box, and I 100% recommend that you go ahead and do this. It's free. Why would you not? It's an absolutely no-brainer. We've got a few questions through from the Q&A box. So the first one, which has partly been answered, is why are so many millionaires leaving the UK?
Yeah, I mean, obviously, different people will have different reasons. Some of them are doing it for lifestyle. A lot of my friends who live in London, they live in nice areas in London. They're now seeing drug dealers on the streets, and it's when they've got young families, it's just not a desirable place to live. And the second is, if you earn good money, you have to pay high tax. I mean, my tax bill for the last 2 years has been multiple 6 figures. I literally paid it on Monday. Hundreds of thousands of pounds just in corporation tax. It's expensive to be in this country. And for some people who want to live in big cities and have better weather, places like Dubai, when I'm talking specifically about Dubai, but you got Dubai, you got Portugal, even Ireland, there's other places where you get treated better. And if you can remove 25% corporation tax and VAT, you could take a company that's doing zero profit and turn it into a 45% profit company overnight by just changing your tax jurisdiction. So there's lots of reasons, but my friends are mainly leaving for lifestyle and better tax treatment.
Amazing, thank you. The next one from Catherine. What do you need to consider when stress testing properties for social housing and assisted living, and also exit strategies?
So the things you need to consider when stress testing, I mean, there's not a huge amount of stress testing because normally you do it for like a lease. So you buy it for a 5-year lease. So the stress test would be more, I wouldn't necessarily be stress testing it. I'd be more doing an appraisal. The main risks I would look at is, the first would be the strength of covenant. So like, I would be looking for really a PLC, or a big operator that's got a government backed contract. Just somebody you look at and you just think this is a solid covenant, a really strong tenant. That'd be the first thing. And the second thing, which is where I am seeing people make mistakes, is you want to use social housing as a short-term solution. If it lasts forever, great, but you don't want to stack your chairs on the deck of the Titanic. So things like asylum seekers in hotels, that is just not commercially viable. 35,000 people in hotels, and the government are paying £1 million a day. it's going to take years to undo it, but the reality is it's not going to be around forever. Yes, you could do deals now, and I would encourage you to do deals in whichever space you're comfortable, but when the market ends, you want to make sure that the deals you do still stack up. So what I mean by that is when you're stress testing long-term viability, my blocks, for example, we've got, I don't know how many, well over 100 houses and apartments on leases, probably more closer to 200 on 5-year leases. Using my figures, the market rent for like PRS might be £750, whereas we lease them for 625. So we're leasing them below the market rent. So if the lease ends, our rent will actually go up. Although the headache will go up because we'll have management and costs and stuff, the rent will actually go up. But I see some people who've got maybe the market rent 750 and they're managing to get 850, 950, 1200 from some sort of social lease. The challenge there is if you've geared up based on that, or your numbers don't work below that because you've spent 500 grand converting it into specialist supported housing and that niche goes, they're the main two risks, I would say. One is, over-egging your rents, and the second is covenant strength.
Amazing. Got lots of people signing up to your webinar. If you have signed up to the webinar, then just drop a emoji in the chat box so that we can see how many people are going to join us. A question from Beta. How do you secure funding given the high competition? She's a complete beginner and most banks see her as a risk. So essentially, what would you say for a brand new starter?
Well, I'd say two things. One is everyone's got to start somewhere. So start off with a buy to. Everyone has to buy their first properties. So I started off with single let flats. I probably wouldn't buy single let. I wouldn't buy individual flats now in the main, and I'll just buy. For yourselves, I just wouldn't recommend it in most cases. But start off with like individual houses because that's where everyone starts, and then work up to HMOs, small blocks, bigger blocks, bridging, commercial. And so you've got to go on that journey. And then the second is the best way to learn is to find somebody that's already done it. So I started off with, I obviously got trained with Simon, and that gave me the confidence and the clarity to go and do it. I also joint ventured, so I bought deals from deal packages, or I joint ventured with other investors and used their credibility. And they put the money in, and I put the energy in, and they put I found the deals, and they sort of looked over my shoulder and made sure I was doing the right thing. So I'd say go through the gears and get some training, and find some people that can, either come in as a joint venture partner or can, invest with you, and that'll sort of solve your problem. It's nowhere near, although it might seem intimidating, if you actually commit to it, it's not as hard as you think, genuinely.
Amazing, thank you. One of the best bits of advice I learned early on was the best investment you can make is investing in your education. And Dan has, everyone I know who has done well in property has invested in their education, guys. So well done for being here on your Saturday as well. Our next question comes from Salish. There's so many people in the property game and getting bigger. Is it advisable to get into property investing?
I mean, hopefully I've given you that answer through the presentation. 100%. Yes, yes, it's big money, big numbers. Yes, there's risks, 100%. But when you understand it and you're educated, it's one of the most lucrative things you can do for yourself and your family. I don't know any other asset class. I've had all sorts of businesses, trading businesses, event companies. I've still got, I've had all sorts of companies. I don't know any other asset class or business model that can create the level of long-term wealth that property does. I've bought companies, I've sold companies, I've grown companies, I've owned and run companies, and really, someone said to me, where have I made my big money? It's been in the properties I own, without a doubt. That's that is what it is.
Amazing, thank you. Sarah has asked what the top property investment strategy is for the next 12 months. Sarah, if you sign up to this webinar, you're going to get the top 3 deal strategies from Dan himself, and they are invaluable. So I definitely recommend it, and he's doing that completely free. The link is in the chat box. The chat box has gone crazy, by the way, Dan, with everyone saying that they've signed up.
Excellent.
So you can have a nice and busy webinar. Joe has asked if the taxes are better in places like Dubai, would you buy property there? And if not, why not? So
this is a really good question. And although I say Dubai because it's the hot topic, there's lots of other countries. There's Cyprus, there's Portugal, there's Ireland, there's endless options. So it's not just Dubai, but there's other. It depends what you want, lifestyle wise, location wise, family wise. It depends. So any other country. The general rule of thumb with investing overseas, if you ask any experienced, seasoned investor who has actively done it, and it's not their niche, is it's a bad idea. Back in the day it was Bulgaria. You've had, if you go to even countries like Spain, you still go to places and there's big half-built blocks. There's people like you and I who got seduced by a shiny brochure, a hot market, a good salesperson, and it wasn't all it was cracked up to be. I think this is a good example of where you've got to manage the risk. And I do think about it. I've got friends who are buying stuff in Dubai, literally like off plan, and by the time it's built, it's gone from, it's doubled in value. I am potentially going to buy an apartment in Dubai to get a golden visa, maybe. But that's not necessarily purely for investment purposes. My general sentiment would be don't. That's my general sentiment, is unless it's somewhere you want to live or a holiday home or you really know what you're doing, I would say the idea of buying property overseas, if you speak to any big names who've done it, for them it's been a disaster, and I would just put it in the category of stuff I as a broad stroke, I just don't do.
Amazing. I think we've got time for one more question. So someone's asked about commercial property, and also Amy has asked what your views are on owning a buy-to-let in your own name.
Owning a buy-to-let in your own name is not a good idea. In the main, unless you know something I don't. The general rule of thumb now is if you own property in your own name, you're going to get taxed on the income. You're now paying national insurance on the income. You can't offset the mortgage. So there's lots of reasons why you don't want it. And if you already own it, you might not be able to incorporate it or move it, but you can use some advanced tax structures to mitigate that. But nowadays, what the UK government appear to be doing and have done for over 10 years is really they're trying to move out the old cottage sort of industry of independent landlords, Mr. and Mrs. Jones, and they're trying to bring in the more structured business corporates to professionalize it. That's what they're trying to do. And the big thing now is really, most people now, anyone I would advise tends to buy their properties in a limited company. That's just the way it works now. Go and seek your own tax advice. I'm not a tax advisor, but in most cases, I don't see anyone buying in their own name now, in the main, apart from residential homes.
Amazing. Thank you so much, Dan. If you do have any more questions, please get joined up to his webinar on the 15th of January. He will do a reveal of the top 3 deal strategies for 2026. Thank you so much for joining us, Dan. It has been a pleasure, as always, and I will see you soon. Have a good weekend.
Thank you, Katie. Have a great day, everyone. I hope you enjoy it. Take care. See you on the follow-up webinar.
Bye. So, guys, that was Daniel Hill, and what an incredible presentation to start the day off. Just a run through for the agenda for the rest of the day for those who have joined us a little bit later. Next up, we've got Alex Daly, how to build a bulletproof portfolio in 2026 and beyond. We've then got Kevin Whelan, how to find new sources of money for your property journey. Rhett Brewer, Property Filter, the gold mining tool. David and Sam McHattie, why SA should be part of your investment strategy in 2026. We have then got a lunch break and our VIP call with Simon. Simon Zucci is then talking about how to win a fully paid scholarship for the Property Mastermind worth £30,000. We've got Richie Clapson, less deals, bigger profits, faster results. Stuart Scott, replace your income with high-end HMO cash flow. Simon Zucci, the number 1 skill that can change your results in property investing. Lee Blake, how to get motivated sellers to contact you every day with below market deals. And then we will round off the day at 5:30. Just a reminder for those who have